Hello traders, welcome to the LFB and our global video charting review. This is for the week commencing February the 14th, 2011. My name's Marco Haig from the LFB trade team, and the content and detail that we're going through is being provided by the automated trading program, which sends signals out to client accounts via Tradency and FXCM. It has to be remembered that there is a disclaimer posted to the LFB website. Forex trading does involve substantial risk, is not suitable for everybody, and we do ask that you read and accept the disclaimers before taking information from the video. Cash may trump equities this week. Global interest rate and equity markets maintain their momentum to hold yearly highs going into a week that's full of red flag economic releases. Having absorbed a heavy reversal off a test of support on Friday, European and US equity trade went on to close last week at the highs of the year. Friday's moves led to a gap higher that we can see in Asian equity markets that reversed for session of Asian equity market selling. As earnings season starts to unwind, there may be a period of equity consolidation as attention turns this week to regional economic reports and to the reality of next quarter's earnings season having to absorb some heavy moves higher in commodity values that have created inflationary pressures. The Japanese Nikkei opened higher to create a gap in price as this week's trading session got underway, which will now battle heavy resistance that we can see up at the 10,750 area. A new long signal will be taken off the next test of support rather than trying to buy this breakout from the current extended levels. Nikkei traders will be looking for a reversal to the 10,650 area for confirmation that support is in place and to go long from there when the subsequent signal is then created, because there's quite a drop in Nikkei equity trade. Held support on Friday, but this gap high, I've got to understand on Nikkei movement, this gap high really only came from the momentum seen on Wall Street trade. German DAX trade started the week with a move higher, similar to the Asian markets, and tested the 74.25 price point as upside resistance. We can also see on our swing points that are issued by the automated trading program, 74.37 is very, very strong resistance, with 74.77 just above that. We failed initially on the German DAX to hold that higher ground. The buy signal on Thursday that came with a break above 73.50, which we can see on these charts here, that was issued on Thursday, has now completed its target. That was at 7400 was the upside target, and it looks as though the path of least resistance would now be for consolidation as traders patiently wait for a retest of last week's 73.50 breakout area. It may be unwise to be looking for new long positions at these extended areas. Patience should be practiced whilst waiting for the market to confirm its continued bullish sentiment. Wall Street equity trade has seen the S&P 500 futures market reverse off of any test of support during 2011, which is in line with the Federal Reserve mandate that's creating equity liquidity via the primary dealers on POMO auction days. Also remember the pattern of trade in 2010. The equity positions were held for an average of 22 seconds, and also that Mondays were very bullish, and we've probably got the potential for upside movement on the S&P, but you need to take care here. The buy signal on Friday to go long from 13.17, which we can see on our charts here, that completed the upside target at 13.25. But now we need to be careful. Traders will be looking for a test of support around the 13.20 area in S&P cash trade during the course of Monday before deciding where momentum and sentiment is going to go. Although bullish, equity markets now absorb a heavy week of economic releases from most global regions, which will create intraday volatility as fair value is adjusted as each 8-hour regional market opens and closes. In general, global equity markets are now at an inflection point. Although still very much in bullish mode, they offer little in the way of decent potential reward when compared to the potential risk that the next test of support fails to hold. In the new generation soundbite headline world that creates price action breakouts and reversals out of nowhere sometimes, it should be remembered that cash is still king. On those days that participation levels are low and price action just consolidates after some of these heavy moves. When market participants start to bank profit off those equity moves that have sent stocks up to yearly highs in general, cash may become the position to hold whilst that consolidation is absorbed. As we can see, the 10-year Treasury note is consolidating in a sideways channel that's lasted for 6 sessions now after a drop in value that sent interest rates up to yearly highs. Two sides of this 10-year Treasury note, the note value goes down, which we can see here as interest rates go up and vice versa. But it's the 10-year note that sets most interbank lending, your credit card, mortgage rates. That's what are geared from 10-year Treasury note values. Signaling on the interest rate markets here, again, that cash positions may be just what an overextended equity market needs, while fair value is adjusted during the course of this week. That wraps up our review of the equity markets. Keep an eye open for the commodity and the foreign exchange reviews, which are coming along very soon.